Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. At the request of a FastGraphs subscriber, I was recently asked to provide a video covering the recently announced merger between Bristol Myers and Celgene. And I think it's an interesting request because these are two very interesting companies that I personally am long in both of them in portfolios. However, they're long in portfolios for different reasons. So let's quickly start out by looking at the different characteristics of the company. I'm going to take price off the graph here, and I want to just look at the business model of both companies. As you can see here, Bristol Myers is a semi-cyclical dividend growth stock. Their dividend record has been very consistent and steady. The company's earnings growth has only averaged about 3.8%. So it's a low growth stock. It does offer a very high yield of 3.57%. It's A+ rated with only 26% debt. Now, if I contrast this dividend payer to Celgene, which is much more of a growth stock, you will see that Celgene has extremely high growth. And I'm going to shorten this time frame because you got some aberrant numbers here. The earnings growth going back since 2007 has averaged over 30%. If I look at just the last 10 years, which is about 8 years, including a couple years of forecast, it's still over 20%. But I want you to notice there's no white line or no dividend on this particular company. This is purely a quintessential example of a growth stock. It's BBB+ rated, but does have 69% debt. Now, when I put price on the graph, if I look at Celgene, relative to its earnings growth of over 20%, the stock is currently available at a low PE of 9.5. Now, the merger deal by Bristol Myers brings us up to about $74 billion in market cap. So there is some upside to Celgene shareholders just in the merger itself. However, if I look at it from the standpoint of the valuation of both companies, Celgene is clearly very undervalued right now. But if I look at Bristol Myers Squibb, even though it's a low growth company, here I'm using a 15 PE ratio, it is also very undervalued. Again, the difference is this pays a very attractive 3.57, we'll call it 3.6% dividend yield. And that dividend has grown, albeit ever so slowly over the years, averaging about 3% per annum, which is very consistent with the company's dividend growth. But it has been a low growth, high yielding dividend paying stock that makes it attractive. Now, by bringing in Celgene, there's a couple of things that happen. First of all, both companies are undervalued, as I've recently demonstrated. But the real difference here is that Celgene is more of a growth stock. So what this does for the Bristol Myers shareholder is it brings it in a growth component, a company that's capable of generating a lot faster future earnings growth. The future expectation for Celgene is about 13.5%. Regarding Bristol Myers, the forecast earnings growth rate is about 7%. The long-term trend line growth is about 5.5%. Now, what I believe this merger is capable of doing is unlocking shareholder value, because Bristol Myers is currently very undervalued and Celgene is also very undervalued. So first of all, I think it's going to create an opportunity to unlock the value of both companies. The Bristol Myers shareholders will get some reinvigorated growth potential. The Celgene investors will get the potential for some dividend income, although what the yield of the combined companies will be and what the dividend policies will be is still yet to be determined. I do consider that one of the real risks of investing in this stock. But one thing I also want to point out about these companies, Celgene has a lot more debt than Bristol Myers does. However, if I go into fund graphs, or what we call financial underlying numbers, and I go into the in millions graph here, and then go into the cash flow statement, I want you to notice that Celgene, last year they generated about $5.1 billion. The year before that, about $5.2 billion in operating cash flow, and about $4.9 and $4.8 billion of free cash flow, respectively. So this company does generate a significant amount of cash flows. In contrast, Bristol Myers also generates about $5 billion in operating cash flow and about $4 billion in free cash flow. So one thing that I think this combined merger does, it brings in a whole lot of cash flow, which will enable it to handle the debt changes on both companies, as well as potentially supporting a dividend going forward. Now, on May 25th, 2019, Bristol Myers sent a letter to their shareholders, which was titled here as Selling the Benefits of the Celgene Merger, and I thought it was worth spending a little time to go over that. It's a $74 billion bid. Management believes it's a good fit with its three pillars of business development, strategic alignment with well-known therapeutic areas, compelling science, and financial discipline. The combined company will be number one in oncology and cardiovascular, and in the top 5 in immunology and inflammation. It will have 9 blockbusters, which are expected to have at least $1 billion in annual sales, 6 near-term launch candidates, and more than 50 phase 1 and phase 2 clinical programs. Now, a lot of those won't come to pass. It significantly reduces the concentration of Bristol Myers' 3 products from 70% to 45%, but Celgene also brings several late-stage pipeline representing $15 billion in non-risk adjusted revenue potential, and they list the 3 here. It will deliver $2.5 billion. The combined company will deliver $2.5 billion in sustainable synergies, and it will be 40% accretive to earnings in year 1 and 10% accretive each year thereafter through 2025. The internal rate of return of 11% will be above the cost of capital, and it will enable Bristol Myers, according to the Bristol Myers Company, to buy the whole necklace instead of stringing the pearls together. Now, in summary, I want to reiterate a couple of points. Bristol Myers Squibb is obviously a very high-yielding dividend, what I'll call very slow dividend growth company with, again, a good high current yield. It has a much higher credit rating and a much better balance sheet, in my opinion. With that said, Celgene, in contrast, although both companies are similar in size, Bristol Myers has a $75 billion market cap. Celgene has a $66 billion market cap, but that'll be going up to the, technically $74 billion according to the merger agreement. But the point is, we have no dividends here and a lot of dividends in Bristol Myers. Now, Bristol Myers did talk in some letters that they've written describing the transaction that the company expects about $45 billion in combined cash flow over the next 3 to 5 years, and that will allow them to actually maintain their dividend policy. So it appears at this stage of the merger that Bristol Myers does intend on continuing their dividend policy. But I've yet to see anything specific. Will they maintain the dividend at its current rate? Will they raise it? Will they decrease it? Will it grow faster in the future than it has now? I think is all yet to be determined. But I do like the idea. The one thing I like best about this merger is that I consider both of these companies undervalued relative to their fundamentals and fundamental potential. And therefore, I do think that this might possibly be an opportunity to unlock shareholder value for both companies. Bristol Myers will get an acceleration in growth, and Celgene will get some dividend income as well as some synergies that I mentioned earlier in the video. Anyway, this is Chuck Carnevale saying thanks for watching. I do find the Celgene Bristol Myers merger quite interesting. If you like this video and are interested in seeing more, please don't forget to hit our subscribe button. And also, you might also want to consider taking a look at a FastGraph subscription for yourself. It's the Fundamentals Analyzer software tool, and I call it Tool to Think With. It provides essential fundamentals at a glance, and I wouldn't even dream of investing in stocks without the benefit and the insights that FastGraphs give me. I think it could do the same for you. Anyway, thanks for watching. This is Chuck Carnevale.